This is, Jerry's got a question related to the married put technique. And it's a question related to different types of structures that one can use. I think I know why Jerry's asking this question, but that's okay. So in relation to let me just take a look here. I know which one's my worst performer. Let me see if there's a terrible stock today. It's HIQ, that looks familiar. Health Insurance Innovations, down 282. Okay, so let's take that one. We'll take HIIQ. And it dropped about $3 today, so it was around $22, almost $23 a couple days ago. Okay, so let's say my cost basis for HIIQ, which was, yeah, no, I'm sorry, $22.65, okay, before this decline today. It's 22, let's just call it $22.50, all right? All right. So one thing I could do, if I had bought shares of HIIQ a few days ago, the cost basis of $22.50, and now the stock has moved against me, I might be able to do a stock repair. What the stock repair allows me to do is we just put in our costs. I'm going to stick with $22.50, and my number of shares, let's keep the math simple and just use 100. And what this tool is going to do is attempt to build ratio repairs that can help me get back to break even faster. If I do nothing, and I'm down this $2.70 or so on this position, $2.60, I need the stock to move up $2.60 to $22.50 to get back to break even. What the repairs do for me is that it gives me a combination of buying a 19 strike, there's my buy strike column, when I'm buying it'd be one of those, and selling twice as many at the higher strike, in this case, for January, the 21. Now I'm going to get a net credit of 25 cents, but my new break-even is only $20.63. Well, how does that work? I got a 25-cent net credit, so my cost is still $22.25. How's my break-even $20.63? Because effectively what this creates for you is a bull call debit spread that you're paid to own for 25 cents. So I'm buying one call at 19, and I'm selling two calls at 21. Now normally that would be a ratio spread, and one of these two would be naked. I'd have a naked call, which carries infinite risk. But I own the stock, so what I really have is a bull call debit combined with a covered call. And if the stock's trading at $20.63, I keep my 25-cent net credit, and my 19 strike call, this is at January expiration, of course, my 19 strike call is going to be worth $1.60 of intrinsic value, $1.63. My two calls at 22 expire worthless. I'm sorry, 21 expire worthless. I sell to close this 19 call for $1.63. I keep that. My original cost basis was $22.50, so I'm still down $1.87, but I just made it back. And of course, if the stock goes to 21, which would still be below my break even, we see here, sorry, I prefer green, ladies and gentlemen, not that brown color. We see here that I have a max profit of 75 cents, even though I'm still $1.50 below my original cost basis. Okay, so great to see it numerically. That's what the breakdown does. We're buying one and selling two. It's a ratio spread, but because we own the stock, it looks like a bull call debit spread with a covered call, but we get a credit off of it to help lower the cost. That's the stock repair. Better to see it graphically. Let's take our example, click on Analyze Trade here, and that'll take us back to the profit and loss chart we were just looking at a moment ago for Paul's question. Okay, so there's my stock price, now trading at 1986. Buying at 265 for January, selling two. January 21 calls for $1.45, so we take in 290. There's my 25-cent net credit for the options transactions. And there's my break-even. I'm sorry, this didn't finish loading before I moved. Fantastic. There's my new break-even at $20.62, just about $2 below my cost basis, and I could still make 3.4% in the next 40 days if it goes above 21. That's the magic of the stock repair. Now, to be fair, this likely fell to earnings, so we probably would have overpaid for a put in a married put position, but we want to take a look at that. And so what we're going to do, the same thing that we did on that historical chain with our previous position on Shopify. Shopify, yeah, the Shopify view. I want to look at the chain for HIIQ. And let's just go back a few days. Let's call it December 17th, Tuesday. Let's see where we were on Tuesday. All right, 22.20, close enough. And it was running up in that day. Didn't quite breach 22.50, but that's okay. Now, Jerry's question was, can I use the stock repair in a married put position if the stock falls in price? The answer is yes, because that's income method number 5. But in a straight married put combination, you don't want to use it that way. Let me explain why. May series is 150 days, the most minimum I would go, but we'll use it for our example. I probably would have tried to get the 24 put, but geez, that looks expensive. A lot of implied volatility, that's why. So this is going to be an ugly trade, Jerry, but we're going to take a look at it. Maybe I'll just fake some numbers so it looks like a normal 6% risk. Why don't we do that? Let's go back to the custom spread builder. And this was obviously due to earnings or some other event that was coming up, which is why those options had implied volatility even out to May of 1,000% or 100%, excuse me. All right, so what did I say? The stock was at 22.50. I'm going to try the 24. A good price, I think, would be in a normal married put, normal volatility. I'm going to say it would be about 410 to 420. Let's try 410. No, still too high. Oh, I was thinking if I went to the 25. I'm going straight to the 24. Okay, yeah, so let's knock that down a lot. Let's do 325. That should be better. 6.8%, still pretty high, but pretty good. So what did I do? I entered a married put position with 150 days minimum to go. Stock was at 22.50. I got my single-digit risk by going with strike or 2 in the money, and we've got ourselves an under 7% risk for 150 days. Usually for 150 days only, I try to keep that down to 5%, but we'll go with this. Now, what did we already see? And this, Jerry, you and I had this discussion, I believe, a couple months ago in relation to the on semiconductor married put in my portfolio, maybe even the Dell one, but I think the on one is one that looks like it has a good repair available that I might use in the next couple of days, but I might do something else first. I probably will do something, but it might be in the next couple of days. In any case, we already saw that HIIQ has a stock repair. Due to January 19 and the 21s, that's going to give us 25-cent net credit and a potential $2 back, and that got us to a profit of 3.4% if the stock was above 21. Well, let's go ahead and input that into our married put structure. Go to January, 19 call, and sell 221s. Okay, and I'm going to do a little bit better on this one because the stock repair wasn't using midpoint. I got to get the programmers on that. You saw that we were buying the 19 at 265 and selling the 21s at 145. That was at the natural. So maybe it's okay to leave the natural because that would have been the worst case scenario for the repair. But let's do this. We're going to get the same prices here. Let's put in the same prices. 265 for our long, selling 2 at 145, so we get 290. There's our 25-cent net credit. So the stock repair should work perfectly fine. Okay. Whoa. What happened? Max risk went up. The return shot up pretty good as well. So this looks pretty good. Where's the risk, though, in this scenario? Why did the risk go up if I took a 25-cent net credit? Shouldn't it have gone down in price? I think the problem here is because if the stock continues to move up, we've got a problem. This maximum risk of 250 now is not if the stock goes down to 0. It's going in the other direction. If it spikes up to maybe, let's say, $30 or $40 per share, we start probably getting into that loss range, I believe. Well, maybe not. It's $1. See, part of the problem here is not maybe illustrating it the best, but when we were talking about just a stock repair, Jerry, we were talking about owning the stock at $22.50. We had a pretty good repair here with HIAQ, didn't we? That looked fantastic. And we can still get a strong return here on this position, but it doesn't stay that way if the stock continues up. There's only 3%. It's a peak here of profit. And then it falls off. And why? Because number one, the total cost into our structure is not $22.50. It started off at $25.85. I'm sorry, $25.75. Stock plus put. That's the money I have into the position. I still have to account for that put cost in the married put position. Now we have the 19 and the 21 call. That's great. We get a 25-cent net credit. So our new cost basis is $25.50. But I'm giving up my shares of stock at 21. Right? Not 25. Not near my cost basis. If I got assigned, I'd be giving up at 21, and I get the $2 from the debit from the 19 to 21 one bull call debit spread. I get that $2 if everything works out right. And then I give the stock back here at 21. So we get about 23 back. Assigned at 21. $2 for the debit. That's my $23. My cost base is still $25.50. So how can I have a return of 16%? Well, because in this case, if the stock was at 21 or 22, my put is still going to be worth $3, $3.20, $3.10, somewhere in that range. It's still going to have profit, so I'm still going to be able to liquidate at that time for a profit. Okay? But it's strange that that risk that's coming in, that $250 that's coming in, is simply due to the fact that I'm not at break even here as I was with a standard stock repair because my cost is actually $25.50, not $22.50. Okay, there it is. James brings the question. He says, could you just put in the $25.50, and that would be minus the 25 cents, so the $25.75 into the stock repair. I could, but what would happen in this case is it might likely not find a stock repair that works because the cost is too high. Okay, so, $25.75, stock and put combination together, 100 shares. Does that January repair still pop up? No. I have to go out to May, get a $1.30 net credit to lower the break-even down. Now again, the put is not a wasted value, but I can't just use the purchase price, Jerry, into the stock repair tool and think that's going to work if a repair comes up because I have to factor in the price of the put, otherwise it won't work. Meaning that you can enter the stock repair and it might repair the stock, but overall the position's still going to be at a loss. Less of a loss than if you hadn't done it, but you might lock yourself into a loss as the stock moves up, where the married put might have still come back to a profitable position. Example, let's see if I have it here. I've got my two new positions here. I want to go back here. Oh, sorry. Wrong view. These are for the webinars this week. The two new positions I opened on Fabrinet and Yandex. And, do I have it in here? I don't think I did. Okay, I never entered it into this from the webinar portfolio. But that's okay. So that's, just wanted to mention, that's sort of the risk with the stock repair. And let me just try to fake the other one you might be curious about. ON, 100 shares. Is my cost that high? Was it 23? Oh, it was. It was at 23. Okay. And January, this cycle, blah, 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 25. No. Okay. Let's see what we've got here. Sorry about that. Let's add the stock in first. That would work, huh? Let me try 335. Let's see if that gets us what I want. Yeah, it's close enough. It's more like a 7% risk on the position that I started off with instead of 5%. We'll use it. This is a married put I'm in. Roughly, it's pretty close. I think, like I said, I think the risk is a little higher. I think it's at the 7% range, 6.8% range. On is coming up to expiration on my put. It hadn't done much for me. This stock, I should have done one very drastic thing. This is the last 3 months, but I've been in this for almost a year. So let's just go back the last 6 months, though. You can see it there, most of it. I bought the stock originally at around I think $23 per share. And it was probably in this range. Yeah, 22 sounds about right, 21.80. It was in this range. And then it just collapsed. But I had the put. Well, it's down at 17, wanted to come back, and then clipped right back down to 17 again. So while I'm deciding, hey, is now a time to maneuver this? Do I think it's going to recover? I didn't see it. I started to move here. It did start the recovery. I should have moved the put down here, taking advantage, but then it fell again. So my risk would have been nearly double had I done that. I didn't. So now as it started to recover, this one I should have moved the put down from 25 to about 22 or 23, and then we would have been looking pretty good. But again, we're near this point here at 25. So now that the stock has reached this point, it is highly likely that I can use a stock repair on this position. And that's why I mentioned to you, Jerry, that in a few days I'm likely going to do something in those lines with this. Even though I've lost a lot of time value on the put, in this case, because the stock didn't perform as I wanted, I probably should have just closed it for a 2% loss earlier on, but that's okay. But I know I have a January cycle, and let me just see. I was looking today and nothing was available. The 24.25 is close. The 23.25 does not exist. I'm just eyeballing it right now, and the 23.24 looks really attractive. Because what do I want to do? I want to buy one here and sell two, but I want to make sure I get a credit. I don't want to do this at a debit if possible. Okay, so the 23.24 is really close. Buy one of the 23s, sell two of the 24s, but I just don't think it's going to give me enough bang for the buck to make up for the time value loss I've taken on the put position. Oh, these aren't my numbers, but yeah, profit of 104 is better than a loss, huh? Yes, Sam, it is ITM. I just have to decide something. This is, I looked at the two, and the reason why I did this one, Sam, is I want to decide. Now you see that risk going up here. It double dips down. Is because, how do I want to phrase this without sounding like I'm giving advice? Do we still have steam? You yourself even mentioned that Apple was losing steam, okay? So if I do this repair at the 23.24 and I get a small net credit here of about 20 cents or so, and ON starts to pull back, well, maybe if it goes down to 23.50, 23.40, that 23 will still hold some value. My fear is forcing that deep out of the money one by buying the 24 and selling the 25, getting a 5-cent net credit, and then having the stock fall, and it really didn't help me hedge anything by more than 5 cents. Right? That would have been the combination. And I'd love to do the 2-point spread that we saw in HIQ. I would love to buy the 23 and sell 2 25s and get a net credit, but they're only trading at 40 cents. It's not there. And I'm not going past January at this time because that's where I put an April put. That's why it looks strange. I have a January put, not the April put. My apologies. So I'm coming up to this expiration. So that might even be vastly different, believe it or not. Even though it's different time value, I might not have a profit with the correct January put, in this case, Jerry, which is what I saw earlier this week when it was at 23. And when ON hit 23 the other day, I was really excited to try to look for a 22.24, possibly a 23.25. The 23.24 was there, just as we're seeing now, that 1 point. But with the put, sorry folks, that I had purchased coming up to expiration, the graph didn't, that's what I was seeing yesterday. Better than the full loss, but I've just created a butterfly. right? A synthetic butterfly in a sense. It's hard to say that when we talk about synthetic, you think you're changing stock for options. A butterfly is typically all options, so I've created a butterfly using stock, so we can call it a synthetic butterfly. It's kind of strange, isn't it? But I wasn't even at a peak profit, so that's why I'm hesitant to use the stock repair. Now, when the stock was at 23, we're at 24.12 now. When it reached 23 yesterday, Jerry, what I was thinking about doing is rolling down this put to lower the cost basis and extending it out to April, which would increase the cost basis, and then doing the stock repair because the put would retain more time value. In this case, we know this put's going to go to just intrinsic value or to zero if it keeps climbing. Okay, that's why this graph's a little bit harder. But if it was the April put, you saw there would be benefit to doing this. That's what I have to consider. So I've given you insight into almost 3 little income methods there for those of you that don't own the blueprint. It's not overly complicated because it's spelled out. IM number 5 is one of the more difficult ones to understand. It is just the stock repair, but done in the proper way if the stock moves up and reaches your goals on the position. Now that not all, I almost walked into that trap, but now that some of the fears of the increased tariffs and trade wars with China have been alleviated off of some of these semiconductors, now may be a time to extend this position because it looks like it's poised for a bigger run if the market doesn't hesitate and pull back due to the fact that it just wants to let off steam. Okay. Sam brings up a comment here with our original structure with the January. Let me go back to that at 335, whatever my price was there. Okay. Why not sell a put and make it a bull put? Well, for fear of correction. All right, for fear of this stock dropping back down to 17 if another tariff or another trade war, or more tariffs, I should say, just that fashion, more tariffs are released on China, semiconductors, Dell, those things would get hit quickly, okay? But Sam's right, say, okay, well, let me get into this. Let me get some premium here. Let me go ahead and sell the out-of-the-money 24 put for 65 cents. No, that's bear put debit. My other put would have to be in the money to do the bull put, Sam, because remember, I'm holding the 25. Okay, so that would put me at a bear put debit, which I'm not sure that I want. But again, I'm collecting 65 cents of premium, and I could sell a call against it too. But now what happens? The put that I own can only cover the stock or the naked put. It can't cover both. I'm back to a risk that I don't want if new tariffs come out again before January and it drops back down to that $19, $18, $17 range. Okay, so that's a concern there. That's why I'm not doing it. Now, your other suggestion would be to create a true bull put. What I have to do is sell the higher strike put for January that's in the money. So I could sell, let's say, the 27 strike for about $265. This would almost make up for the time value I currently have lost on the put. Not all of it, because if it goes above 25, I'm losing all of that. But same thing happens again. Right? The stock's here, I'm at closer to a break even on this position. You're absolutely right, Sam. But now if the stock falls, I'm going to have to potentially buy shares of stock at this price. I'm using an in-the-money bull put, which is set up to take the full loss on the position. Even though I still look like I'm having a small profit on the stock, this new bull put I created would be at full loss. And it would be pretty significant. Now, this maximum risk, remember, is if the stock falls all the way down here, I'm going to lose the 6, if it goes to 0, I'm going to lose the 6% on the married put and the full bull put spread amount. Right? So, it's a good thought. Just don't like the lack of protection because this thing has seen a drop down to 17. And I'm not sure if something new happens in the economy, the global economy, that it's possible that could have that drop again. So, Jerry, in relation to what you were saying, powerful tool, stock repair tool. But if you're going to use the stock repair tool to analyze fixed on a married put, remember, number 1, use the cost basis of the stock plus the put to see if a repair exists, not just the stock. If you do use just the stock and you find a repair, go to the profit and loss of your existing Mary put and graph it, because you might not like how it looks, and it might not give you the same benefit that you're seeing of just doing the stock repair against the stock without considering the cost basis of the put option. Those are my suggestions there on using that. That ratio spread is one of the income methods. It's income method number 5, but it's usually done in a different context. It likely can be used in this situation, but you have to prepare yourself that you might be locked into a loss depending on how far the stock has already dropped and how much time value you've given back for the put option itself.